My name is Martin King and I'm property analyst at Edison. I'm joined today by Stephen Inglis, Chief Executive of London and Scottish Property Investment Management, or LSPIM, which is the asset manager to Regional REIT. Stephen also represents LSPIM on the board of Regional REIT as a non-executive director. He's here to discuss the recent Regional REIT half-year results to 30th of June, the company's strategy of focusing on regional office properties and the outlook. Welcome, Stephen.
Good afternoon.
Could we start perhaps with a short overview of the half-year results?
Of course. So you're delighted with the results. H1 for us in terms of 2021 has been a challenging period, obviously, and challenging for the vast majority of the economy. But just looking at the highlights of our half year, dividends declared of 3.2 pence, in line with expectations, and targeting a full year dividend of 6.5 pence. We're already now in late September and have good visibility of income, and therefore I can say that will be the case, and indeed will be fully covered. Just looking at performance over the period, I mean, since IPO, our fund has produced a plus 39.9% return against the FTSE EPRA NAREIT UK index, the index in which we're judged against, of only 4.7%. So a massive outperformance. Annualized, that's an annualized return of 6.1% against the index of 0.8%. So again, pretty good in terms of the index. I think it's also worth pointing out that that return is in cash. That is the dividends we have paid out over the course of our journey so far in the stock market, and I think that's notable. So that's not paper gains, that's actually cash paid. Just looking at a dividend yield, I mean, against current valuation, that's roughly 7.5%, one of the highest dividends in the market currently. Even against NTA, 6.6%. And whilst we are trading at a small discount to NTA just now, we'd expect that to recover as we begin to see more confidence coming back into our chosen sector, the regional office market. NTA itself up marginally from the half year, 99.1 pence rather than the 98.6 at the end of 2020. And that's really down to a combination of some small sales and a couple of asset management initiatives coming to fruition and being reflected in the valuation for the portfolio. On valuation, well, we forecast a flat value for the first 6 months. We had reasonable visibility of what was happening in the market, having been downgraded unfairly, in my opinion, twice over the course of 2020, both in June and December. Based purely on sentiment, nothing in terms of transactional evidence, and therefore we expected valuations to flatten. That kind of points to the fact that the market has, in this current cycle, bottomed in terms of certainly the valuation world, and therefore we're not anticipating any nasty surprises moving forward. And as a bit of confidence comes back into the market, we may even see a small uplift in value. I don't expect to see that by the end of this year, but certainly coming into 2022, June, December, there may well be some more positivity around by then. We over the period, we undertook £4.3 million of capital expenditure. That's not yet reflected in the valuations as is normal. That will flow through. And we maintained LTV at just under the 40%, 40% being our target LTV. That was maintained just under 40%, 39.8% for the period. So overall, I think pretty strong performance. I think we're happy the way things have gone in the circumstances, and a global pandemic and nobody being in their office for 2 large lockdown periods. I think the results look very strong. The one thing I'd really like to focus on, though, is our rent collection levels. 99.1% so far and growing. I think that is exceptional in the circumstances when people actually have not been in occupation of their offices. We're already now seeing a return of people in any real numbers. So I think we've demonstrated throughout 2020 strong rent collection statistics. That continues. Obviously, Q3 and Q4 are now out as well. The numbers look strong for those quarters too. So that clearly, that strong rent collection enables us to be pretty confident in terms of dividends.
And since closing H1, your move to becoming a pure play regional office investor has really taken shape. Can you talk about the key transactions that you've undertaken?
Sure. I mean, we obviously announced some time ago a slight tweak to our investment strategy. We had previously invested both in multi-let industrial and offices. Our own view was that multi-let industrials had plateaued in terms of performance. We think yields had fallen substantially with little or no rental growth prospects on the assets that we held. And therefore, we took the opportunity to sell those assets and recycle into what we saw as better growth potential assets, being regional offices. So that move to becoming a pure regional office REIT has made a significant step forward, as you alluded to. Obviously, we announced 2 weeks ago the acquisition of the Squarestone portfolio. That was a £236 million acquisition of mainly office assets. Of the 31 assets we acquired, there are 27 regional office assets, 2 small industrial assets, a residential which is attached to one of the office buildings, and a small drive-through. So, the attraction of that portfolio was that the quality of buildings was very high. The occupancy level at roughly 75%, so lots of upside for us in terms of leasing as activity, as we expect will come through. Capital value, £136 a square foot, so a 30% discount to replacement cost. Still very attractive and actually very much in line with the existing portfolio. Rents, £13.39 per square foot on the let space, £11.04 overall, against an ERV of £15. So one can see how we can grow the value of that portfolio both in rental income terms and in capital terms over a relatively short period, and that was a very attractive acquisition. We believe we have bought at or about the bottom of the market in this current cycle. The other thing I think worth bearing in mind is the construct of that deal, and we issued 3 component parts: share issuance, the value of just over £83 million. That share issuance was at NAV, or NTA as we call it these days, so NTA at 99 pence against a trading price obviously 10 to 15% below that, actually 14% at the time. We also recycled the proceeds of the sale of an industrial portfolio, roughly £76 million, and £76 million of additional debt. So to acquire a £236 million portfolio for a relatively modest equity investment, I think is something that we're very proud of. Secondly, I think you look at what the overlap might be in the attraction for us, well, the quality of the buildings I've mentioned, but also 75% of the income from that portfolio is in established locations where we already have assets and see them as long-term prospects. That was attractive to us. That's not to say the other 25% isn't in locations we want to be. Rather the opposite. It's just that we didn't have any representation in those towns and cities prior to this acquisition. The other thing, obviously, one of our big things is diversification of income. Lots of tenants doing lots of different things. Therefore, ultimately, our income being as broad as we possibly can. 30% only is the overlap of tenants. So of the entire rent roll, 30% of the rent is from tenants that we already have represented in our portfolio. So much broader spread of income. And that was a very much one of the main reasons for the acquisition.
The future of the office has been much debated over the last year, and I know you've done an awful lot of work and research on that in shaping strategy. Could you say a little bit more about that, and also what you're seeing nearer term on the ground?
Yeah, I mean, I think the future of the office has been debated for some time, and there were changes happening even prior to the pandemic. I mean, you know, things in offices that were previously the realm of the Silicon Valley giants were becoming mainstream, and we saw lots more breakout areas, relaxation areas, yoga rooms being introduced. You know, the idea of collaborative working and informal discussions, all of that was becoming part of the general office environment anyway. I think what the pandemic has done is exacerbated that, and the whole process has been speeded up. The other aspect, and one of the reasons for that coming into the market prior to the pandemic, was purely companies recognizing that to attract and retain quality staff, they had to offer better facilities and better quality accommodation. And that's not in terms of, you know, the four walls of an office building are almost the same regardless. It's about the fit out of the building and the way it's used and the fit out of your own office space. And that will almost certainly come through to what the Americans call de-densification. So more space per person. So the idea that this has been created because of social distancing from the pandemic is a bit of a misnomer. It was happening anyway. So yes, of course, people now recognize that if there's a bit of social distancing, they're perhaps a little bit protected from the cold, the flu, you know, coronavirus, whatever the next thing may be. So that's definitely an element. But the main element was actually, you know, treating people with the respect they deserve and giving them facilities that would be attractive to them in retaining them as good quality staff members and new staff. So that will undoubtedly fuel demand. And I think that will undoubtedly come through. It will take time. You know, there will be early adopters and there'll be later adopters, but undoubtedly the market is moving that way. In terms of return to the office, we are seeing a gradual return. We'll hopefully have some reliable statistics over the next 2 or 3 weeks, because it really has been a large return post the English school holidays. So September, last 2 or 3 weeks from the schools going back, has seen a large influx of people into offices. So what I can say is the vast majority of our tenants are back in. What level of occupancy is per office is what I'm referring to in terms of reliable information, and we'll hopefully have that in the next 2 or 3 weeks. But we think it's about 40 to 45% of people back in just now. And then we expect that to be a gradual drift of more and more. The way people are working, undoubtedly, the majority are adopting the hybrid model, and that hybrid model being mainly Tuesday, Wednesday, and Thursday office working. And therefore, you know, we have a situation where people are working from home Mondays and Fridays just now, and that seems to be the commonly adopted methodology. It'll be interesting to see how that develops over the course of the next 6 months, year or so. As companies try different methodologies of working, they'll eventually test that methodology, and then they'll either adopt that as a long-term strategy or they'll adapt in some way. But what tenants are telling us is that they expect the majority of their staff to be in the majority of time. So we'll see how that develops in the next few months and years.
Just returning to immediate prospects, you mentioned the dividend target that you have set for the year, and the ambition that we fully covered by earnings. That implies some acceleration in earnings in the second half of the year. Could you just talk about the elements to that?
So I think if you track our earnings since we've been on market, our second half earnings are always stronger than our first half, and there's a few reasons for that. I mean, one is there are actually a few extra rental days in the second half, obviously of February, and the way that quarter dates fall, there's a few extra days rent in the second half. Secondly, all things that are settled, for example, dilapidations claims, early surrender settlements, any disputes where we may have taken provisions for rents and we eventually collect those rents, nearly always are settled in the run up to the end of the year. And therefore, second half earnings are always more than the first half earnings in terms of our historic earnings. So really, that's the main difference, and that's why you will see 3.5 pence or more earnings in the second half of the year.
And can I press you perhaps to look out slightly further through next year and beyond in terms of the outlook?
Sure. So while we're very positive in terms of the outlook for occupation and ultimately, increasing earnings, we do anticipate that will take some time to come through. So we are anticipating things to be flat for the remainder of 2021, improving slightly into 2022, but really the main improvement probably coming towards the end of 2022 and into 2023. That's when we expect earnings to substantially improve, and that will allow us to continue with our progressive dividend policy.